Ladies and gentlemen, something happened in the gold and silver market this week that almost nobody saw coming. Not because the information was hidden, not because the numbers were impossible to find, but because most investors were watching the wrong thing. They were watching the price of gold. They were watching the price of silver. They were watching the headlines. But they were not watching the one signal that has the power to change the entire direction of precious metals in a matter of days. Interest rates. Because in just 1 week, the odds of a Federal Reserve decision that could create serious pressure on gold and silver changed dramatically. A possibility that many investors considered unlikely suddenly became a scenario markets were forced to take seriously. And that single shift changed the conversation. Because when expectations around interest rates move, everything connected to money moves with them. Stocks, bonds, currencies, and especially the metals that have protected wealth for thousands of years. Gold, silver, the assets that do not pay interest, the assets that cannot be printed, the assets that millions of investors hold because they fear what governments and financial systems cannot control. And that is why this moment matters. Because if you own gold or silver, the question is not simply, will the price go up tomorrow? The real question is, do you understand the forces that are pushing it? Because markets do not punish people for being wrong. They punish people for being unprepared. And right now, something has changed. Something that could create a storm in the short term, but also reveal something much bigger happening beneath the surface. For years, gold investors have understood one simple idea. When confidence in money weakens, demand for gold rises. When inflation threatens purchasing power, people look for protection. When governments accumulate debt, investors begin searching for assets that cannot be created with a keyboard. That is why gold has survived every empire, every currency crisis, every financial panic. But there is another force that constantly fights against gold. And that force is interest rates. This is where many investors become confused. They understand gold, they understand inflation, but they underestimate the power of central banks. The Federal Reserve does not mine gold. It does not own silver bars sitting in a vault. But every decision it makes changes the environment around these metals. And the reason is surprisingly simple. Gold and silver do not generate income. If you own an ounce of gold, that ounce does not send you a check every month. It does not pay dividends. It does not produce earnings. It simply sits there. And that has always been both its weakness and its strength. Because when interest rates are low, investors are more comfortable owning assets that preserve value. But when interest rates rise, the calculation changes. Suddenly, investors can earn meaningful returns from government bonds or savings accounts. Money begins asking a question. Why hold an asset that pays nothing when another asset is offering a guaranteed return? And that is where pressure begins. Higher interest rates create competition for gold and silver. They increase the opportunity cost of owning precious metals. Think about it this way. Imagine two choices. One option is an asset that simply stores value. The other option pays you interest every year. When rates are high, many investors move toward the second option. When rates fall, the appeal of the first option increases. That simple relationship has influenced gold markets for decades. But here is where the current situation becomes interesting, because this is not happening in a normal environment. The world today is dealing with problems that did not exist in previous cycles. Government debt levels have reached historic extremes. Inflation has challenged central banks around the world. Geopolitical tensions have increased uncertainty. And investors are questioning whether traditional financial systems are as stable as they once appeared. This creates a difficult balancing act for the Federal Reserve. On one side, the Fed wants inflation under control. Because inflation reduces purchasing power. It hurts consumers. It damages confidence. But on the other side, higher interest rates create pressure on debt. They make borrowing more expensive. They slow economic activity. And they increase the cost of servicing massive government obligations. It is a situation where every decision creates consequences. And investors know that. That is why markets react so violently to even small changes in Federal Reserve expectations. Because behind every rate decision is a bigger question. How long can this financial environment continue? This is why investors were caught off guard. Many expected the path ahead to be predictable. They expected inflation to continue cooling. They expected interest rates to eventually move lower. They expected gold and silver to benefit from that shift. But markets changed their expectations quickly. Economic data came in stronger than expected. Inflation concerns returned. Energy prices created additional uncertainty. And suddenly, the possibility of a more aggressive Federal Reserve became something investors could not ignore. The market went from confidence to caution, from certainty to uncertainty, and uncertainty is where volatility is born. Because markets are not moved only by what happens. They are moved by what people think will happen. This is something legendary investors have understood for generations. The biggest market moves often happen before the event itself, not after. Prices move because investors are constantly trying to predict the future. When expectations change, prices adjust. That is why a Federal Reserve meeting can move gold hundreds of dollars even before a single policy decision is announced. The market is not waiting for the news. The market is trying to front-run the news. And that is why understanding the psychology behind these moves matters. Because fear can create opportunities. But fear can also create mistakes. History has shown this repeatedly. When investors see gold falling, many assume the story is over. When silver drops, many believe the opportunity has disappeared. But often, the moments when confidence is lowest are the moments when the biggest long-term shifts are quietly developing. And this is where the bigger story begins. Because the short-term pressure on gold and silver is real. A stronger dollar can hurt metals. Higher rates can pressure demand. A hawkish Federal Reserve can create selling. Nobody should ignore those risks. But the smartest investors do not look at only one side of the equation. They ask a deeper question. What forces are temporary, and what forces are permanent? A Federal Reserve decision can change overnight. A headline can disappear tomorrow. A market panic can fade within weeks. But debt trends, currency concerns, and global demand for real assets develop over years. And that is the battle currently taking place. A short-term fight between interest rates and precious metals. Against a long-term shift in how investors think about money itself. The biggest mistake investors make during moments like this is focusing only on what is happening today. They look at one headline, one Federal Reserve comment, one market drop, one red candle on a chart. And they believe they are seeing the entire story. But markets are rarely moved by one event. They are moved by forces building underneath the surface long before the crowd notices. And right now, several powerful forces are colliding at the same time. Interest rates, inflation, government debt, currency concerns, geopolitical uncertainty, and a growing demand from some of the largest financial institutions in the world for something that cannot be printed. Gold. Because while many individual investors are focused on whether gold rises or falls this week, some of the biggest players on earth are thinking in decades. And that difference in time horizon changes everything. One of the most important voices in global finance has repeatedly warned investors that the world is entering a period of unusual uncertainty. Jamie Dimon has spent years discussing the risks created by inflation, government debt, geopolitical conflicts, and changes in the global financial system. His message has not been that investors should panic. His message has been that they should pay attention. Because according to Dimon, the biggest risks are often the ones that markets ignore because they feel uncomfortable. And that is exactly what makes today's environment so interesting. For years, investors became comfortable with a world of low inflation, cheap money, and predictable central bank policy. Interest rates stayed low. Governments borrowed heavily. Markets continued rising. It created a sense that this environment could continue forever. But financial history has always shown one important lesson. No cycle lasts forever. Eventually, the consequences of easy money appear. Eventually, debt matters. Eventually, investors start asking whether the value of money itself is changing. And that is where precious metals become part of the conversation. The hidden force behind gold's long-term appeal has always been simple. Gold is nobody's liability. A government bond depends on the government. A bank deposit depends on the banking system. A currency depends on trust in the institution issuing it. Gold does not depend on anyone keeping a promise. That is why, during periods of uncertainty, investors often return to it. Not because gold is perfect. Not because gold rises every year. But because it represents something rare in finance. A store of value outside the traditional system. Now consider the problem facing central banks around the world. They are trying to fight inflation without creating economic damage. But inflation is not only a number on a report. It represents a loss of purchasing power. A dollar today does not buy what the same dollar bought decades ago. A lifetime of savings can slowly lose strength if the value of money declines faster than people expect. This is why inflation creates emotional reactions. Because it is not just about markets. It is about people's lives. It affects retirement savings. It affects the cost of homes. It affects everyday expenses. And when people lose confidence in the future purchasing power of money, they often search for assets that can preserve wealth. That is where gold and silver enter the picture. But there is another group watching this market very closely: central banks themselves. And this is one of the most fascinating parts of the current gold story. While some investors sell gold because of short-term price movements, many central banks have been increasing their gold reserves. Why? Because central banks understand something that individual investors sometimes forget. Currencies can change. Political situations can change. Financial relationships between countries can change. But gold has maintained value across centuries. Central banks are not buying gold because they expect a quick price move tomorrow morning. They are buying because they are thinking about financial security over decades. They are asking a much bigger question. What assets do we want to hold if the global financial environment becomes more uncertain? And for many of them, the answer has been gold. This creates an interesting contradiction. The average investor often thinks, gold is falling, maybe I should sell. But institutions often think differently. The price is lower. Is this an opportunity to increase our position? The difference is psychology. Short-term investors react to emotions. Long-term investors analyze cycles. And history shows this difference repeatedly. Look back at the 1970s. Inflation was high. Energy prices were rising. Confidence in currencies was weakening. Many investors believed gold was too risky. There were periods where gold experienced painful declines. People who bought near highs became frustrated. Many sold because they believed the story was over. But those who understood the deeper forces saw something different. They saw inflation. They saw declining confidence in paper currencies. They saw a world searching for protection. Gold eventually went from roughly $35 an ounce at the start of the decade to around $850 an ounce by 1980. The people who focused only on short-term volatility missed the larger transformation. A similar lesson appeared during the global financial crisis. Before 2008, many investors believed major financial institutions were safer than they actually were. Risk looked invisible. Markets appeared stable. Then suddenly, everything changed. Banks failed. Markets collapsed. Investors rushed towards safety. The lesson was not that every prediction comes true. The lesson was that risks often become obvious only after they have already arrived. And that is the question facing investors today. Are gold and silver reacting only to short-term interest rate pressure? Or are they responding to a deeper shift happening inside the global financial system? The answer may be both. In the short term, rates matter. The Federal Reserve matters. The dollar matters. But over the long term, the bigger forces remain. Massive debt levels. Currency uncertainty. Central bank demand. And the search for financial protection. This is where many investors make their biggest mistake. They confuse a temporary decline with a permanent change in the story. They see a storm and assume the climate has changed forever. But experienced investors know the difference. A storm is temporary. A tide is different. A storm can shake the surface. A tide changes the entire landscape. And right now, gold and silver investors are trying to determine which one they are facing. A temporary storm caused by higher rates. Or a long-term tide driven by debt, inflation, and changing confidence in financial systems? The answer will not be decided by one trading day. It will be revealed through the decisions made by governments, central banks, and investors around the world. The greatest danger for a gold or silver investor is not always a falling price. Sometimes, the greatest danger is misunderstanding what that falling price means. Because every major financial cycle creates the same emotional test. The market sends a signal. Fear rises. Headlines become louder. Investors begin questioning everything they believed. And in those moments, the difference between successful investors and unsuccessful investors is rarely intelligence. It is discipline. It is the ability to look beyond the next few days and understand the forces shaping the next few years. And right now, the biggest forces are not found only inside a Federal Reserve meeting room. They are found in something much larger. Debt, currency confidence, and a world becoming increasingly uncertain. For decades, governments around the world have expanded their debt levels. Borrowing became easier, interest rates stayed lower, and financial markets became accustomed to a world where money was abundant. But debt creates a hidden pressure. Eventually, the question is no longer, can governments borrow more? The question becomes, how long can the system continue without consequences? This is why investors pay attention to government debt. Not because debt automatically creates a crisis tomorrow, but because debt changes the choices available in the future. When debt levels become extremely large, every percentage point increase in interest rates matters. Higher rates mean higher borrowing costs. Higher borrowing costs create pressure on governments, companies, and consumers. And that creates a difficult situation for policymakers. They want to fight inflation, but they also know that keeping rates high for too long creates economic pain. This is the financial balancing act happening beneath the headlines. And then there is the question of currency confidence. Every major currency in history has depended on one thing: trust. Trust that the government will manage the system responsibly. Trust that purchasing power will remain stable. Trust that savings today will still have value tomorrow. But when investors begin questioning that trust, they search for alternatives. That is why gold has remained relevant for thousands of years. Not because it is a perfect investment. Not because it rises every single year. But because it represents something different. It is an asset that does not depend on another institution keeping a promise. And in uncertain times, that characteristic becomes valuable. Geopolitical risk adds another layer to this story. The modern world is not operating in a period of complete stability. Trade relationships are changing. Nations are competing for economic influence. Energy markets remain vulnerable to disruptions. Political decisions can quickly affect financial markets. And whenever uncertainty increases, investors often look for assets that can survive outside traditional systems. This is one reason central banks have continued paying attention to gold. They are not thinking like day traders. They are thinking like governments planning for decades. But what happens next? What are the possible paths for gold and silver? There are three realistic scenarios investors should understand. Scenario 1, the short-term pressure continues. In this scenario, inflation remains stubborn. The Federal Reserve stays aggressive. Interest rates remain higher for longer. The dollar strengthens. And investors continue choosing yield-producing assets over precious metals. Under this outcome, gold and silver could face additional short-term pressure. Prices could fall. Sentiment could become extremely negative. And many investors could begin believing the entire gold story is finished. But history teaches an important lesson. A decline does not always mean the end of a trend. Sometimes, it is simply a difficult chapter inside a larger story. Scenario 2, inflation cools and the Fed changes direction. The second possibility is very different. Economic growth slows. Inflation continues moving lower. The Federal Reserve becomes more comfortable reducing interest rates. And investors begin anticipating easier monetary conditions. When rates fall, one of the biggest disadvantages facing gold disappears. The opportunity cost becomes smaller. Demand for alternative stores of value can increase. In this environment, precious metals could regain momentum as investors prepare for a new financial cycle. Scenario 3, a bigger financial shock changes everything. The third scenario is the one that many long-term investors worry about. A major geopolitical event. A financial crisis. A sudden loss of confidence. A situation where investors stop asking, "What return can I earn?" and start asking, "Where can I protect what I already have?" This is historically when gold's role becomes most important. During periods of uncertainty, gold is not valuable because it creates wealth. It is valuable because it protects wealth. That distinction matters. But regardless of which scenario unfolds, one thing remains constant. The biggest enemy of investors is often not the market. It is emotion. Fear causes people to make decisions at exactly the wrong moment. They buy after prices rise because they feel safe. They sell after prices fall because they feel afraid. They allow headlines to control decisions that should be based on strategy. This pattern has repeated for generations. During market crashes, people sell because they believe the future will be worse. During bubbles, people buy because they believe the future will always be better. Both decisions are usually driven by emotion. And emotion is expensive. The investors who survive difficult periods understand one simple truth. Markets move in cycles. Confidence rises. Confidence falls. Fear appears. Opportunities appear. The question is not whether volatility will happen. The question is whether you will understand it when it does. This is why the smartest investors do not ask, "Is gold going up tomorrow?" They ask, "What role does gold play in my overall financial protection?" They understand that 1 week does not define a decade. One Federal Reserve decision does not determine the future of money. And one market decline does not erase thousands of years of history. So as we look ahead, remember this. The short term is always noisy. The headlines are always dramatic. Markets will always find something to worry about. But beneath all of that noise are the forces that truly matter. Debt, currency confidence, global uncertainty, and the decisions being made by the largest financial institutions in the world. Those forces move slowly, but they move powerfully. The next few weeks may test gold and silver investors. There may be volatility. There may be fear. There may be moments when people question their decisions. But history has shown that the investors who protect their wealth are not always the ones who predict every move correctly. They are the ones who understand why they own what they own. Because knowledge creates patience. And patience creates opportunity. Now I want to hear from you. If you own gold or silver, what worries you more right now? Is it the possibility of higher interest rates? Is it inflation? Is it government debt? Or is it the uncertainty happening around the world? Share your thoughts in the comments below. Because many investors are watching this conversation, and your experience could help someone else make a calmer, more informed decision. And if this video helped you understand the forces moving behind gold and silver, not just the headlines, but the bigger picture, make sure to subscribe. Because the next major shift in markets will not happen when everyone is prepared. It will happen when most people are still trying to understand what changed. The investors who succeed are usually not the ones who react first. They are the ones who understand first. So remember, a storm can shake the surface, but a tide changes the direction of the entire ocean.